Good afternoon, and thank you for joining us for today's Market Update webinar. My name is Tom Morr, and I am the head of the Client Advisor team at Simon Quick. And I am pleased to be hosting today's discussion alongside my colleague, Wayne Yee, our Chief Investment Officer. 2 weeks ago, two large banks experienced a bank run that caused the FDIC to step in and take over both organizations. Since that moment, we have seen significant volatility in the banking sector, and coupled with rising interest rates and overall market uncertainty, it leads us into today's discussion. Wayne and I will spend some time discussing the events of the last week, but more importantly, how we interpret them and what are the effects on markets and in client portfolios going forward. I will then open the floor to Q&A. Please hold your questions until the end of the discussion and use the Q&A function on the Zoom to submit. Darcy O'Brien is administering from behind the scenes if there are any difficulties. I'd also like to mention that this call is being recorded and will be posted to our website and circulated over email tomorrow. Before I kick us off, as usual, I am going to read a brief disclaimer. This presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. And with that, let's get started. Hey, Wayne, how you doing?
Hey, Tom, good to see you. It's a tough disclaimer to follow.
Exactly. You ready to get into this? We got a packed agenda here.
All right, let's go.
All right, so really I want to start off here, and before we get into the events of the last 2 weeks that have been in the news, seemingly from dusk till dawn, and even in the past few hours with the Fed coming out and the interest rate decision and the hike, I'd like to spend a few minutes, if you will, on the market sentiment coming off of 2022, in which we saw equities down around 20%, traditional fixed income down in the double digits. The conversation still centered around inflation and interest rates. Can you, just to get us started, just quickly talk about the first 2.5 months of 2023 and how investors were feeling at the beginning of the year?
Yeah, maybe just to set the stage a little bit from what we saw last year, not to kind of belabor all the inflation and interest rate commentary, but it really did begin last year, right? We saw 9% inflation. The Fed was likely slow, we could all argue, slow to start raising rates, but once they were at it, they went really aggressively. 25 basis point hike, 50, then was a 475 basis point hikes. We saw going from 0 to the 4.5 really quickly. So that was the big move that we saw last year, and that really changed the bond market dynamic. And that's what really kind of percolated into all the challenges that we're seeing in the banks. But nonetheless, the economy did slow last year, but was still growing, just at a slower pace. Inflation was still a pressure. The Fed need to really keep inflation in check and really dampen inflation dramatically, and that's what drove their Fed policy. But because of that action, it created a lot of pressure across the banking system. It wasn't really felt to a huge degree until very recently. Now, we could say, yes, housing slowed down, maybe housing purchase slowed down because mortgage rates jumped up to 7%. But consumers were still out there spending and living their lives, traveling, services, all that was still there. So the overall economy still felt safe on the street. But what was brewing in the background was that it's just getting much more expensive to run your business. It was harder to make a profit, and notably within the banking sector that came under extreme pressure. But just really the market, to your comment earlier, equities were down about 19%. Fixed income bonds, the Barclays Ag as the proxy, was down about 13%. Very tough environment where you couldn't win in stocks or bonds, where traditionally they would offset each other. That was what happened over the course of the entirety of 2022. But if you think about the back quarter, just the final 3 months of the year, you did see a recovery. Both stocks and bonds, unfortunately, both were moving up in the same direction, but both stocks and bonds were positive in that final quarter. And why? Like, what drove that? This changing sentiment and view that maybe the U.S. can make it through. Maybe the economy is resilient enough that we will see a slowing in growth, but we can avoid a recession. The Fed may be closer to the top of its hiking cycle than the middle or early stages. So maybe we can have this kind of steady growth opportunity that doesn't force the economy to turn over. And that's what really set the stage for the start of this year, 2023. You saw a big rally in equities to kick it off. both equities and fixed income, to kick it off in January. You saw some weakness in February, but then March, it's surprising, right? We're talking about two of the top 20 banks failing, a third on the precipice, Credit Suisse being taken over. But equity markets, kind of barring today, were largely flat, which is really interesting. There's a lot of stuff going on and commentary about this feeling like maybe a mini '08 or what have you. Yet equity markets were relatively resilient in the midst of all this. And we'll touch on what the Fed did today to kind of support some of that. But there were definitely creaks and cracks that we're seeing in the system, notably within financials, notably within regional banks, and you saw a lot of pressure there. And the tone has changed. And even going into some of the commentary that Chairman Powell put out today, while banking, we need to preserve the integrity of the banking system, inflation is still a challenge. We still need to really curtail it before it extends too far. He committed to getting inflation down to 2%. And I think the market's just kind of heard 2%, we're not there. Maybe there isn't a pivot. Maybe we stop hiking, but this kind of immediate reversal is maybe a couple of years out. And let's reprice the risk. Maybe there is greater financial constraint out there. And that's probably what's addressing the final couple, maybe hour or so of the market today. But that's where we stand today.
Right. And we'll definitely get into more of that as we go along. But just to piggyback off your points, the market was a good final 3 months of the year, was really rally into January. And then we really get into the last 2 weeks specifically. And it all started with SVB, Silicon Valley Bank, but it's really rippled into the rest of the banking sector. SVB, a bank, primarily serves the innovation economy, technology, venture capital, healthcare, private equity. And at the beginning of the year, the bank came in with over $200 billion of assets, which had, I think, doubled over the past 2 or 3 years. There was tremendous growth in that area, lending to these types of companies. Going into this year, again, was strong. What happened, Wayne? What happened in these last 2 weeks, in your own words? Heard a lot of news come out about it, but how would you describe what's transpired here?
And people finally cared, right? Like the balance sheets broadly across banks were coming under pressure in the vein that you have longer duration, high quality assets that were very interest rate sensitive. You were technically losing money if you were going to sell it, but if you didn't have to sell it, you don't have to mark your book. So that's the way the banks were operating. And a significant bank like JP Morgan has many sources of assets and liabilities to drive that business. So they weren't beholden to any single kind of funding structure. Silicon Valley, to your point, grew tremendously. There were other risk management control elements that probably were lacking there as well. We won't go too far into that. But because of that, on that 2 weeks ago, I think it was Tuesday, Powell was indicating towards more aggressive hiking, and the market was pricing in maybe a 50 basis point hike. And then Wednesday after market close, Silicon Valley announces that they need to raise $2 billion to fill a capital shortfall, which was to solve for something they already fixed. Now, there were probably more things that they needed to fix, but they are already fixing the shortfall or fix this kind of asset liability mismatch to some degree. But going out into the market and announcing it just kind of really opened up investors and depositors' eyes and say, maybe there's a lot more risk into the system here that was driven by the rapid rise in rates. If it happened over a longer extended period of time, I think it'd have been more manageable. It happened within 12 months. And that sudden move was what really caught banking balance sheets off sides. And that just snowballed. It just became this kind of crisis of confidence because Wednesday, SVB announces that they need to raise this money. Thursday, because of Silicon Valley's focus on the tech and innovation and venture community, you saw all those customers and depositors start scrambling to move that money. And a bank uses deposits to fund its asset base. And if you're losing your deposits, you can no longer support what other investments you have. And you start selling your investments, which causes you to sell at a loss as well. So that's the snowballing effect. And then they said, okay, SVB is dead. Friday morning, they don't open their doors. But then everyone started looking at what's the next bank and what's the next bank after that, and how do we start avoiding some of this kind of going out of Silicon Valley into Signature, into PacWest or First Republic. Like you just saw this kind of pain kind of percolating in the system, and that's what really led us into the weekend. If the Fed had not taken certain actions, Sunday night, we would have woken up to a much uglier week last week. So in one regard, the Fed did take some appropriate actions to create some stability in the system.
And Wayne, just before we get into the response, it's a very interesting dynamic that you had the same companies and firms who helped grow the bank, right, by giving them the business. They were the ones then pulling out and causing the bank to go through the stress that it went through.
Yeah.
So, I think I still want to spend a couple minutes on Thursday and Friday. We know what the bank was going through, but for my team, the client advisors were reaching out to clients, trying to, at least talk through us gathering information and feeling next steps. But from your team, Wayne, you cover an investment team of 5 analysts. What was your move on Thursday into Friday, and what was your focus on from an investment manager perspective?
Yeah. I want to be clear. I mentioned 08, not because we think that this would be like an 08 crisis, but more so, there are a lot of things that we learned on the back of the GFC, which I think were highly prescriptive in terms of how we should approach any kind of financial situation. And right off the bat, Friday morning, we're emailing, we're calling our managers to get an understanding of what is their underlying risk to Silicon Valley. And it's not just, okay, is it Silicon Valley? If you have exposure, what are you doing? Where are you going? That's that's step number one across all our investment managers. And we do invest in venture managers here as well. We do have a long-term strategic view on the growth opportunity within venture capital investments. But within those funds, they were the most sensitive. So those were our first calls when we think about that list. The distressed fund or the buyouts, those tend not to be the core market for Silicon Valley Bank. But the venture and the growth oriented, those were. So reaching out to them, understanding where those exposures were, first at the fund level, and then at the underlying level. So it was a scramble, everyone, all hands on deck, reaching out to assess where that exposure would lie. And any money lost would be a negative. But what we did appreciate was that it was a relatively isolated exposure in terms of the majors that did utilize Silicon Valley Bank. And even from that perspective, as a fund investor, you tend not to have a lot of money just sitting in a bank. That's not really the purpose of investing in a drawdown vehicle. So the overall size of exposure was relatively contained as well. But there was money that was in transit that was not nothing. So understanding that. And kind of updating in terms of it said it was pending in transaction. Did it actually close and move or not? And what is the size of that? And then on the venture funds, what were their underlyings? Because if you recall, that happened on a Friday right before your typical mid-month paycheck. So how were companies going to survive that? And just trying to assess what the underlying exposure to the portfolio companies were. So that's what the real mad scramble over the course of the weekend was, because maybe we had a good handle on the fund level, but what are the potential repercussions at the portfolio company level, and what was the manager going to do if there was money trapped? So that was the core focus. It all came to pass. So then the Fed and FDIC came out with this backstop and kind of deposit protection program that happened Sunday night. But it doesn't end there, right? It's like, okay, good. We just got, a lot of companies got this lifeline, but if you end it there, that's where you make the mistake. So it's like, okay, so SVB deposits are safe. What's next? What are you doing next? And what are you learning from here? Because in this environment, private equity, we're not really focused on dual banking or having kind of separate accounts and kind of the things that a hedge fund that might use leverage and prime brokers and custodians, there was a different degree because it was meant to be a much simpler process within private equity. So those are some of the learnings that GPs are picking up right now and addressing and implementing into their system. So even today, that's what we're leaning on our managers. Just kind of, where are you on the process? Who did you find? If you use another regional, why regional versus a big bank? And kind of walking through those elements.
Right. And, as you mentioned, we saw first SVB, then Signature, then you started hearing about First Republic, and then Credit Suisse came into all this. And can you just talk about the immediate decision over that weekend, how it rippled into the rest of the banking community, and then is Credit Suisse associated with this? Do they have their own unique circumstances that transpired that just happened to culminate with everything else? But talk a little bit about the banking sector overall.
Yeah, I mean, there's two interesting comments. I'll touch on Credit Suisse first, and I'll bring it back home. But Credit Suisse was a quickly diminishing bank over the course, quickly meaning over the past maybe year and a half. They had a lot of operational challenges. There was executive leadership turnover. The business overall was under a lot of strain. It just happened to coincide that they ultimately needed a bailout by the Swiss National Bank via UBS in this period of US regional bank challenges. But it didn't help the situation because it just caused this crisis of confidence within the financial services system and people being really nervous about where their money was and whether there was viability and access to that. So I would put Credit Suisse a little bit to the side in the vein that it was more idiosyncratic, right, to some degree, but there was the overall environment and the restrictiveness of capital did not help them. But going to the U.S., what we saw was like all the regional banks were losing money, losing deposits. So the bank balance sheets in terms of credit quality still remain really resilient. While the economy was slowing down or has been slowing down over the course of the past year, defaults has still been really low. The quality of the borrower remained consistent, and if not, I'd say high. But it's this interest rate function that really impacted the banks. But that's what caused this kind of run for capital, run to the banks to pull out capital and maybe take it out of a First Republic and move it to a JP Morgan or a Citi or a Bank of America. So it was these big banks that were winning in this deposit move, while the small banks broadly were getting negatively impacted, even if they were not part of the headlines, even if they did have a resilient balance sheet. There was this view that why be in a small regional if I had the opportunity to move to a big bank? And what was really interesting on the back of that was JP Morgan came out and said, okay, we had this great idea that we could help these small banks. There probably was some broader regulatory pressure to get them to help out the regionals. But by the 11 banks redepositing their own assets into First Republic as a sign of confidence, I think that was a good move, an efficient move to help support First Republic. At this point, it looks like it's not going to be enough, but it does just give them time to assess opportunities. So that's a way of the large banks saying, hey, there's nothing wrong with the broad system. It is a nuanced element that we are trying to address, and we're all in this together.
Well, to that point, do you see regulatory changes coming out of this?
Yeah. I mean, even Powell talked about it in his press conference too. That they have their own investigation. They welcome other investigations into what the policies and procedures at Silicon Valley. What I just want to distinguish and comment is that it was not solely Silicon Valley didn't go down just because rates went from 0 to 5. But it didn't help the cause, and Silicon Valley had some of its own risk controls that they need to manage from an interest rate perspective, probably less so from a credit quality perspective. In 2008, banks went under in 2008, or banks came under significant pressure because they took aggressive risk. And even when you think about bonds generally, bonds have two components, the interest rate component and then the credit risk component. In 2008, it was the credit risk component that really drove a lot of losses, like ninja loans, like kind of people buying houses with no money down, no verification of income and what have you. That was just bad risk. If you look at balance sheets of banks today, that's not really where the risk was. But because there was less opportunity to invest, they were owning treasuries, which are another government security and high quality assets, but they were just too long in duration. Typically, if you take a deposit that's short term and lend at 1%, and then you make a loan, let's call that 5%, 5 year, that's 5 years long, you should make money. You're making 5%, you only have to pay out 1%. That's a winning trade generally. Now you have to take other kind of loss assumptions and what have you into it. But what really happened was the curve right now, when you look at the front end, like the 6-month part of the treasury curve being in the 4.5%, 4% plus type range, and then looking at the 5, 7, 10 year being under 4%, that mismatch is what really impacted these banks. And the more exposed you were to that mismatch, the more of an issue it was. And that's where Silicon Valley stood.
Right. So just before we get into asset allocation and portfolio construction and feelings around asset classes, cash. Cash has been a hot topic these past 2 weeks. It's an asset class that there was always very little to no risk in that asset class. Now we have investors saying, where do I put my cash? Where can I keep it safe? There's obviously the FDIC limits at banks. You're hearing about investing in money markets or treasuries. What are your thoughts around just the where on holding cash, which is, again, supposed to be what is safe and what is protected?
No, it's a good question, and something that we on the investment team had spent some time in the past when no one cared, when rates were zero. But now it's become another focal point, and why? Because money markets and banks came under a lot of pressure in 2008. So people just same thing, going back to the original playbook and saying, well, what broke then, and are we protected today? So when we look, there's been a lot of regulatory reform that's come into the system that we won't really go into right now. But generally, the FDIC insurance is highly protective. FDIC for banks, SIPC for brokers. But at the FDIC, you have $250K that's supported, up to $250K in deposits that's supported by the federal insurance policy on banks. So you're covered there. So even if a bank goes under, and this was before any government intervention at Silicon Valley, if you had $250K or less, that cash was protected. That is the safest place you could be, because you just know it's cash, it's not going to move. There's no redemption risk or anything. There's no gating feature. It's your money. You get up to $250K. So that is the safest place to be. Thereafter, if under the assumption that you no longer have any other insurance that the government is intervening with, we look at the brokerage accounts and looking at money market funds and treasuries. Okay, in your brokerage account, owning a treasury and owning money market funds, and we'll talk a little bit about that. Owning the treasury is probably the safest because it's the government's obligation, and if the government can't meet that obligation, there are significant other challenges in the world. So it's as safe as you can go. Now, I'll put the asterisks. People want to talk about Bitcoin and gold and what have you, but there's a different level of volatility. So if you want stability of value and protection, a treasury bill or treasury bond is the most assured way to get exposure. But there are mark-to-market elements within treasuries. That has nothing to do with the government. It's just kind of people will buy and sell at different levels. They will never buy more than what they can sell it at. So there's always a bid ask or some margin of spread in there, no matter how small within treasuries. But that is highly protected. And then the next kind of best thing there, we would argue, are money market funds. And when we look at money market funds, we own money market funds backed by treasury and government-backed obligations, because that is where you get your protection, right? So it's a fund. In that fund, there are other investors, yourself as well as everyone else that looks to invest. But the composition of those funds are treasuries and government agency bonds and kind of government-backed obligations, which give me comfort that I should not be at risk of principal loss. It is not as good as owning a treasury. Just want to be kind of completely frank around that. But it is the most liquid thing you can own, knowing the exact amount that you will get, in the sense that a treasury you can buy and sell and there'll be some price discovery on the margin. But a money market fund, as long as it's a treasury-backed constant NAV fund, you put in $1, you'll get $1. You'll get some interest rate on top of it, but you know what you're putting in it, and you know how much you'll get out. And in that vein, there's
I think that's an important point, the treasury-backed money market fund. There are other money market funds out there that might be backed by corporate debt, and that might actually move off the dollar, but we're talking specifically treasury-backed money market.
Yeah, there's prime money market funds that may fluctuate around $1. They'll always hover around $1. So in a benign environment, those are safe. They look safe, you get a higher yield. But I guess money markets are not where we want to try to kind of reach for yield. If you want to do that, there's other high quality investment opportunities. So if you're going to look for this safe cash bucket or this kind of protected bucket, might as well just stay with treasury and govy backed money market funds, because the incremental yield that you're missing out on may not be worth the headache of kind of worrying about whether or not you're going to actually get that money back out. But in that vein, unlevered vehicles that you can, I don't want to talk about what the extremes might look like, but a bank, if you had $1 million with only $250K of protection insurance, theoretically, if you lose 750K out of that million, for a money market to kind of have such a massive run, like it's tremendous. And we're at, like, in those dire situations, we're really thinking about maybe a few points of loss if we even played it out that way. So that it just kind of shows a difference in terms of those vehicles. Really, because money market funds make their money, they make their fee. The manager makes their fee off the management fee within the money market fund. That's why you always see some kind of discount versus the equivalent versus treasuries. Versus the bank, they pay you an interest rate, but they can only pay you so much. So for them, they need to use the leverage to enhance the return opportunity within the bank. So that's why technically in severe scenarios, banks are probably more at risk. Your deposit is more at risk than a fund.
Yeah, I mean, it's still unbelievable to see some banks paying an interest rate of 0.1% in today's current rate environment. But let's switch topics to what I think a lot of people are here for. And, what should people be doing in their portfolios to respond to this current environment, asset class underweights, overweights, changes within asset classes? Like, how are you feeling about broad asset allocation and portfolio construction going ahead, Wayne?
Yeah, I mean, generally, we want to be, we're skewed more towards defensive and volatility aligned strategies. And I'll kind of explain what that means. But just if I think about our equity allocation, we were overweight up until late 21, and we moved that to a more neutral weight. Obviously, knowing what we know, we should have gone underweight, but we wanted to kind of take some of the chips off the table off of a strong 19, 20, 21 type time period. And if you thought, and early last year, what we were doing is, okay, we're trimming back our equity exposure. We actually started increasing our bond exposure, our fixed income exposure. Now, in slow and steady pacing, and we were very short duration, probably 1-2 year duration in the first quarter of last year. We've extended that to about 4-year duration, kind of generically, if we looked at liquid fixed income by the end of last year, but in a slow, measured pace, rather than saying this is it, we're going to load it all in. So that move we think is highly protective, or we think that was the appropriate move because, yeah, last year fixed income was down 13%, which sucks, which is an awful year. Like everyone's written about how awful of a year that was. But if you look over the long term, fixed income is uncorrelated and a protector in economic uncertainty and equity market volatility. And we got to a good place around that today. So we are generally neutral weighted across equities and fixed income. Within equities, we had been heavily domestically oriented. Let's call it the last 4 months of last year, we've been shifting more of that into international defensive, not international cyclical. Just kind of steady, same thing that we look in U.S. companies, just compounding earners as opposed to kind of trying to chase over excessively cheap or cyclical strategies. But in fixed income, we have been moving up in credit quality. We used to have a decent allocation to high yield exposure, which had done really well. We've been gradually shifting that more into investment grade. And we do have some treasury exposure in the portfolio to create that ballast and protection while extending duration. Because if the Fed did actually stop its hiking program, which maybe it looks like we're about a quarter point away from that today, treasuries will do even better. Because then we're going to think about the tightening cycle, or the let's call it the easing cycle of rates, which causes bonds to tighten, and that's a positive gain element beyond just the income that fixed income generates. But what we've really spent a lot of time on and enjoy a lot right now is in the, and it's hard to talk about hedge funds in like with too much kind of positivity, but hedge funds, specifically diversifying hedge funds, multi-strats that are not looking towards directional equity or directional markets and aren't leaning so much in fundamentals. Rather, they're looking to play in volatility, being more balanced on long short, looking at diversified asset classes, whether that's across commodities, FX, fixed income. We think that's a really interesting part of the market now, only because rates are a lot higher. So when rates were zero and volatility was low, there was not a lot to do in long short. You might as well just go long assets and kind of ride that wave. But in a period of greater uncertainty, you do want managers that are long and short at across different things to be able to take advantage of mispricings and then move on. Not being in a trade for too long. It's more about that shorter term, get in, take advantage of that short-term volatility and move on to the next thing without taking on broad market exposure. So we've been steadily increasing that allocation within our hedge fund portfolio. And then the final point in private equity, I mean, private equity has its own kind of opportunities and challenges right now, but we've been spending a lot of time around the dislocation opportunity. We've really not seen defaults or cracks in the private market broadly, or even in the public markets in that case. But with what the Fed is doing, we expect it to come, and we do think that whether it's just to provide liquidity and buy really cheap because you're a liquidity provider, or being able to do workouts and restructurings and own high quality assets on the cheap, that will be a long-term opportunity. So in privates, that's where we've been spending some time. Secondary.
Let's stay there for a second on the illiquid side. There's really record dry powder out there, but pretty low deal volume. So should investors reset their return expectations on the illiquid part of their portfolio, especially because we haven't seen that impact that we've seen in the public part of the portfolio?
Yeah, I think with higher rates, investors should reset expectations across the board, meaning that, all right, we went from 0 to let's call it 5% on Fed funds. So in that big move, if you can make 5% on short duration government exposure, like that just makes other asset classes less interesting. But while it's new for us, or recently, this is a new phenomenon, over the long term, having 4 or 5% type kind of, let's call it 4% type Fed funds rates, it's not new. So we're going back to that point where you don't have to pay up as much when PEs or price to earnings multiples were in the low 20s. Like it was because there was nothing to do from a fixed income perspective. There weren't other asset classes owned, so you had to do that. But in an environment where you can actually make money on fixed income and credit assets within fixed income, equity returns overall will probably come down a little bit. Long-term equity market returns are more in that 8%, not the 12% that we've seen in the most recent decade, let's call it. Fixed income also, we're probably looking more at a 3-4 on a treasury basis, like a 3-4% type yield versus the 0 that we're seeing over the past few years too. So I think it's reset that. Private equity, my general view is that it will come down at the high level. Like if you think about private equity broadly, but within that bucket, it becomes more idiosyncratic. And in that idiosyncrasy, I think there's definitely more opportunity. When you look at asset classes, equity versus fixed versus hedge funds versus private equity, the fattest pitches tend to be in the private markets because it's just less transparent. There's more unique situations, opportunities, more active engagement. So yes, headline, I do think returns will come down. So you'll have to work harder to find kind of good returns there. But I think there will be a lot more opportunities with greater conviction over time. I'm not saying put all your money fully invested in private equity today, but over the long term, it still will be an outperformer versus public markets. And then privates, there's so much. Like as I talked about dislocation, like high quality, dislocated opportunities where you're making 15 to 20% type net IRRs. That's really like I have so much more confidence on that return number in this environment than the typical 20, 25%, but much more equity market sensitivity that we had maybe 2 years ago.
Great. I have 2 or 3 additional questions before we get into the Q&A from the audience. But direct lending has been a popular strategy recently. Do you see an opportunity here, especially what's gone on the past couple of weeks in filling in the gap that maybe was led by the smaller banks in order to lend to some of these smaller middle market companies?
Yeah, the short answer I would say is yes. But I think the refinement of that is like, we don't want to oversell the yes. In the vein that I think incrementally, direct lenders, venture lenders, factoring businesses, where you're just kind of doing more shorter term loans. Like I think all those businesses are kind of coming into the light of kind of venture startup entrepreneurs and what have you. So I think it increases the opportunity set and deal flow. But on the flip side, if the Fed is actually starting to cut rates, then this kind of rising rate environment that we just experienced and saw, direct lending giving you 10%, like that may pull back a little bit. And then you might have some credit sensitivity on the back of that as well. So it does ebb and flow. but generally we do think this creates more opportunity outside the banks and more into private investment opportunities. You have to be selective, but we do think it does make for a better situation from that front. There will be more regulation, right? Banks are highly regulated, but yet you still have issues like this. So we anticipate even further regulation on the banks, and for them to make any money, it's going to be harder for them to do, and they'll do so by lending out less. So as the banks continue to get disintermediated by private lenders, it does create more nuance and more creative opportunities. Like we're seeing deals that a commercial bank cannot do because it might valuate go against a certain regulatory requirement or restriction. Private lenders can take advantage of kind of structured finance, structured equity, prefs. Prefs, it sounds like a dirty word right now, but prefs in a company. So I think there are some much more interesting things that are going on right now in the creative investor lending space versus the commercial banking space.
Good, thanks. And can you spend 2 minutes on real estate? Rising interest rates usually result in falling real estate prices. Commercial real estate was already under pressure during COVID. This might make it even worse. But can you just talk about real estate as an asset class?
Yeah, I mean, in this period, like it was really real estate. Real estate over the long term is a diversifying asset in the vein that it is a inflation-aligned asset class. It's a hard asset, so almost like a commodity, you could own it. That's at the high level. If I owned a house, inflation will make that house more expensive just naturally because of just natural supply of, or lack of supply of land and what have you. But real estate as a business becomes more challenging and more nuanced because the owner of the asset is looking to make a certain return and finance it at a certain level. And when rates move up so dramatically, that does impinge a lot on the underlying kind of profitability or the equity of that real estate asset. So that is coming to, we're seeing a lot of challenge, notably in office, right? Office back on the, since COVID had come under significant pressure. Just offices, I sit in New York City right now, foot traffic is kind of north of half, but kind of nowhere near kind of previous levels that we saw pre-COVID. Leases are getting restructured lower, tenants are leaving. All the tech companies, you're seeing them kind of reduce their footprint as well. So all that is a negative, notably in office. But then there are other opportunities which we think could be good buy situations that are less so real estate let's call it like real estate operator REIT driven. Home builders make homes, but they're not in the business of running or operating homes. So they have built all these assets. They need to unload them. Smart investors are coming in and buying these things cheaply because the home builder doesn't want to hold any inventory. They want to reduce all the inventory that they can so they could get that money and build other houses. But the single family rental, the multifamily space, that they've been able to buy some of these dislocated assets, whether it's out of a B-REIT or a Starwood as well, in addition to the home builders, at much more economic and profitable levels, pricing in a 4 or 5% type interest rate environment than a 1-2%. So that's where the opportunities do reside. Office is under significant pressure. Multifamily from a cost perspective, because wood and what have you, all the materials costs and labor costs are going to really kind of hurt some profitability around there. Multifamily is a high quality long-term defensive asset, but because of that, it tended to be more levered as well. Like if a commercial asset was levered about 60, 65 loan to value, multifamily could be in the 65, 70, 80. 80 is not what we typically see from our investment space, but just generally, individuals getting a loan will likely pay 80% down, so or pay 20% and get 80% financing. So that is where you probably see more pain. So you might see an asset marked down 5, 10%, which doesn't seem dramatic, but if you're levered by more than half, that 10% becomes 20, 25, 30. And that's where the sponsor might say, all right, I don't want this anymore. And that's where the restructuring or dislocation purchase opportunities come in. And we approve one manager from that space, and we're looking at another one.
Great. And lastly, you mentioned crypto gold before.
Yeah.
Thoughts there? Anything change?
Yeah, it's highly volatile. I mean, I didn't look today, but Bitcoin has been on a tear. It is speculative. We would never say, we never took the view that crypto is a commodity. I know that's the long-term kind of thesis behind it, but that's really not our stance. So I understand the concept, but on a practical nature, I don't think the ecosystem and the infrastructure is built out enough for anyone to really be able to invest from that perspective. And gold we view as a commodity, and it's highly volatile in the sense that if I want to preserve assets, I want asset preservation over the long term. And with gold, I think you have to just trade it more. Like, yeah, in these periods of fear, gold does rip, but then you have to sell your gold. Otherwise, when the fear comes down, gold will start selling off again, and you have the risk of, yeah, I might know exactly how many troy ounces of gold I own in my vault, but the prices will shift, and I might not get exactly what I thought I was getting out of that.
Great. So we covered a lot there, even with you talking a million miles an hour. I thought that was great, and it was a really good conversation. And I just want to take some time to open it up to questions from the audience. Please submit your questions using the Q&A function on the Zoom. Just kicking us off, Wayne, the first question that actually came in before the call was centered around, we talked a little bit about the liquid managers and the cash that they had on the sideline, but can you talk about an individual portfolio and somebody holding cash, whether it was a recent liquidity event, a recent bonus payment, or cash that's been sitting on the sideline for a while? It's nice to sit there and earn 3.5 to 4 and change percent with whether it's treasuries or money markets, but what should they start investing and diversifying? And then if that's the case, how do they begin to leg into the market? Should it be all at once? Should it be over time? What's your viewpoint here?
Yeah, I mean, I'm definitely talking my book a little bit, but let's just say over the long term, you want some portion of equity exposure because that is a tax efficient way to grow your wealth. And maybe the start of the comment, like let's say equities were able to give you 10%, and direct lenders today can give you 10%. Let's say they're the same. The 10% you generate via stocks, it's just more tax efficient. So there's some, and that in itself will compound over time. So there's some value to that. So you do want to own equities, fixed income, alts, and privates. We'll talk about all the different sleeves that we work through. But in periods of uncertainty, what you don't want to do is try to chase the most volatile asset, the relatively most volatile asset, and call it. You don't want to call the top nor the bottom because that's very difficult. And you might feel great for a week, but that can turn over in a month. And that's really not the game we want to play. So there should always be, or we think that there should be a component of equities, whether it's 30% or 80%, whatever that level is that's appropriate for your growth needs. You should have that plan and look to set the timing at which how you want to get it deployed. But in heightened periods of volatility, just be methodical in terms of putting that out, whether it's across a few months or a couple quarters, getting it deployed over time. So you're not trying to time that top or bottom, or you won't feel bad if you happen to be at the top, watch it go down, or same case on the bottom, you got some money to work at the bottom and you can continue to build up because we do think that dollar cost averaging element is beneficial in more volatile asset classes. But that's on the equity, on the liquid side. In privates, where it's a drawdown function, you're committing over the course of the next anywhere between 3 to 5 years. The manager is deploying over that period of time. So we think that's a good way of just setting a plan and letting a manager that you would have high conviction in to deploy that capital. In fixed income and hedge funds, we do think hedge funds right now are really interesting because there just continues to be a lot of volatility. And everyone talks about the VIX as like the volatility measure, the fear gauge for equities. That's true. It is a measure for equities, but there's been so much volatility in fixed income right now. And when you look at the respective charts on fixed income versus the equity vol indices, fixed income blows equity out of the water. Equities we're in the 20s from a volatility perspective, which is elevated, but it's in a market where you can operate. But when you look at the MOVE index, MOVE, which is more around treasury and interest rate sensitivity, that chart blew out. I think we're above 2020 levels in terms of volatility from that side. And it cuts both ways, right? Because fixed income was moving out dramatically last year. Fixed income is moving in dramatically this month. So that volatility while people are making money on it, it's highly volatile. And I think there are opportunities that only really hedge fund-like strategies can take advantage of, and kind of being a little bit more tactical and being long and short across that, in the sense of kind of playing in, like, we think structured credit is really interesting, but it's very hard for an individual to buy structured credit assets.
Right.
So having a fund, whether it's a mutual fund structure that can be opportunistic across fixed income, or in a hedge fund that could be maybe even give up some liquidity on the margin, a little bit more liquidity, but really find differentiated ideas, that's really interesting in this environment right now.
Yeah, and I think to your point about equities, just from an advising perspective, right? Coming up with a plan, setting that plan in place, sticking to it, trying to keep emotion out of it as you leg into the market, and potentially even setting bands where you would leg in maybe 2 slugs if the market sells off even more. That's where we've seen the dollar cost averaging work the best and allow people the opportunity to sleep at night as well. Wayne, a question came in on CLOs and really the CLO machine continuing to churn. Is there a view on CLO equity, or is there too much tax leakage for taxable investors there?
It is tax inefficient when you think about just purely the income component of CLO equity. But CLO equity is the residual of all the obligations above it. So there is also a capital appreciation, like a stock. You buy it cheap, and then people say, you know what, it's actually better performing than I anticipated, and it rallies. And there is that capital appreciation component of it as well. So maybe I'll break it up. If the comment is really more around CLOs, levered loans, it's levered debt that spits out a nice coupon. Typically, it's floating rate, so you can move up and down. You definitely benefited last year with rising rates in terms of the income generated from these income structures. Right now, you're gonna probably, you don't feel it immediately, but you'll likely feel if the Fed does start slowing or pulling back a little bit, you'll start seeing that slip a little bit. But still, much better place we are today than we were a couple of years ago. We do think that there is a component of direct lending, whether it's in corporates, even in real estate and other asset classes. There is the opportunity that enhances beyond traditional fixed income, but it's an enhancement to traditional fixed income. It's not this kind of be all and end all in terms of driving long-term returns, particularly because of that tax inefficiency. If you had a tax exempt structure and you could put that into that, what's a retirement account or what have you, or endowments and foundations, love it because you just get great consistency in cash flow. I think that's a great place for stuff like that to reside.
Good. Another question came in, and it's interesting. We talked a lot from the perspective of the depositors at these small regional banks. This question came in and said that they actually own shares in several regional banks. They all have paper losses on their bond holdings. If a bank run starts on any of them, the shares get wiped out when the FDIC takes over the bank. Is this a risk that is worth taking on the equity side?
If this were to become a bigger, you have to think about the valuation at this point. It is a little bit of a catch a falling knife play. The long-term secular story behind regional banks is that they will continue to get consolidated and rolled up by if not the megas, other regionals, and become super regionals and what have you. So there's that nice long-term kind of efficiency and synergy that does come out with owning the regional banks. But they are undiversified at the core. Like part of Silicon Valley, like you can't grow by being diversified right off the bat. You kind of want to. You can't grow quickly unless you're much more concentrated. Silicon Valley grew really quickly, but then wasn't able to diversify. And with all regionals, we do think that they tend to be kind of regionally focused in terms of that economy. Like Silicon Valley Bank being based in San Francisco, obviously you got to get a lot of the tech community banking with you. But if you're in a regional bank in, let's call it Virginia or West Virginia, you're going to have a different industrial kind of composition there. And we think about that when mining started getting shut down or under greater pressure, like you saw banks come under strain from that perspective as well, or even the energy bankers or the oil field bankers in Texas. Like you'd see these pockets of pain amongst regionals. So Yeah, it's a cheap value play. I think if I were to bet, like I think there's probably a saving grace behind it. But is this the right price? I don't know if this is the right price. You look at that sell-off, right? The market's kind of all these stocks coming off, some of them coming off like 60% and still kind of flailing. Yeah, maybe there's a rally here, but are you going to hold on until you make the entire 60% back? Probably not. You're down 60%. You're up 20%, you're still underwater by more than half. So it's like it's more of a tactical, opportunistic trade than something that we kind of lean into.
And okay, thank you, Wayne. And with time for one more question, we had a couple questions come in on real estate funds and strategies for funds in this market environment. So whether it's real estate debt or investments in kind of core real estate, does that turn into a more distressed play, buying off REITs and sponsors? So how do you feel about, you talked about real estate, but how do you feel from a fund perspective investing in that space?
Yeah, generally it goes across the board, right? Like if there's an economic slowdown, we focus on real estate because it's a little bit more topical and people can look at an office and say, oh, that looks like it should be a distressed office given that no one's there and what have you. But real estate generally, alongside corporate lending, generally in a slowing economy, you are going to see defaults pick up. So maybe the question being, well, how does a manager perform in the midst of that? It falls down to good underwriting and restructuring competency, in the sense of if I am a real estate lender, maybe I'm making my 8, 9, 10% income per year. That's great. Like that's nice income to be able to be producing. Generally, when we look at direct lenders, you're looking at anywhere between 2 to 5 year type duration or maturity type loans. So relatively short. You want them to perform during that period. Maybe given the question was around real estate, if you think about real estate lending, there's two camps. There's the fully stabilized lending, which are thin margin and much more sensitive to interest rate risk. Then there's construction, transition, redevelopment lending as well, which are higher coupon, shorter maturity, but your takeout is the building becoming stabilized. So if the building does become stabilized, it would have been a much harder story last year trying to refinance that with long-term debt. It feels like it's getting a little bit better right now, but still probably more on the painful side than the smooth sailing side. Managers that we look at, we want to make sure that there's competency to be able to do a workout if it were to ever come. Not because we're saying that right now, but whenever we underwrote any of our direct lenders from the get-go, we want to know that there is a restructuring workout competency, because if you can own the asset through that down cycle, if you're in the loan, you probably have 20, 30, 40% of equity cushion already. You wipe out that cushion. Now you're the quote unquote the equity, but if it's a good asset, you hold on for another year or two, you'll be able to repurpose that into as long as it's performing as you anticipated and you know how to run that business, then you can kind of refinance it at a more favorable time. And you do have to, it's the strong hands that can hold on in difficult periods. Those are the ones that will be able to put up good numbers consistently.
Appreciate it, Wayne, and thank you for all the insight today. And at this moment, I just want to thank everybody for joining us on the call today. To the friends of Simon Quick, managers, professionals we work with, thank you for your expertise and support in helping us serve our clients. Thank you to the Simon Quick team. Your hard work and dedication to our clients and your fellow employees really inspires me every day. And last but not least, thank you to all of our clients. Without you, we would really not be able to do what we do best. Thank you for your trust and your confidence. Our goal is to continue to raise the bar every day in order to provide you with the freedom to pursue what really matters in your lives. As a reminder, we will be circulating the webinar recording over email tomorrow, and it will also be posted to our blog. If you have any additional questions that we were not able to address during the call, please do not hesitate to reach out to myself, Wayne, or your client advisor team, where we would be happy to address them offline. Thanks again, everybody, for joining us, and have a great afternoon.
Thank you.
Thanks, Wayne.